Okay, so let's do, I have to catch up on, so let's do problem 11, what was the number? 7? 7, yeah. Okay, sheets going around to sign like normal. Obviously, if you're ready to participate, sign and check mark. If you're just here, if you're not here, don't sign anything. Don't do anything. So problem 7. Oh, last point on the exam tomorrow. Do what's required. Okay, so somebody's going to ask this morning the question. If it's an acquisition and control question or a 1321 allocation of proceeds, you only need to do the types of questions that you're asking, right? So if there's a question in there, you need to make sure you only do what you're asking for, no more, no less, right? So let's say you have a question on reallocation of proceeds, and we ask a certain type of question. I'm not giving you an answer there, obviously. Let's pick something like that, kind of blue. You only need to do that part and not the whole full-blown, starting from no election to election with no reallocation. You need to do just what we're asking for, okay? Everybody get that? It's a good question because in class we rattle through 45 minutes or an hour of stuff to get to an answer. Well, sometimes we're only going to want to test you on a part of that just to kind of see you know the fundamental concept, right? Because after a while, we know you can do capital gain calculation. We know you can do certain things. We might be trying to test just a component part of those questions. So, in my opinion, I think that's the best way to test if you got it across a lot of stuff, breadth-wise, as opposed to one big, long question. Okay, is that fair? So take a read of what you asked for and only do what you asked for. If you kind of do a whole lot of stuff, guess what? You're going to get your component marks, but you wasted a lot of time doing stuff you didn't need to do. Okay, so in this question, compute the maximum investment tax credit for Infotech in 2011. Who wants to help me? What's the maximum I can sit there?
You would take the 2.2 million, which is the scientific research and SR&ED incurred,
yep.
And then multiply it by 20%, which is the max rate. So you
Yep.
have 430,000.
Okay, so what's the question? There it is. So basically what they're telling us here is we had $2.2 million of ICC, SRED expenses, multiplied by 20%, you got 440. Is that right? Okay. Okay. I got 2 ladies up the front, more here, so I'm going to get some people who we don't, you ladies I get here from all the time. Let's get some people in. Nina.
So a question. So
Oh.
for SRED,
Yeah.
I thought it was only for like new customers.
Okay, good.
So then for the music credit, you have to do that.
Correct. So Caitlin, that's the trick to this question. No, the trick to this part is only new equipment qualifies, not used stuff. So what you got to do is you have to take out that $200,000 for used equipment. Okay, that's the trick to this question. So the long and short of it is, most of the time, what you put into this, the section 37 pool we talked about the other day, remember we added a bunch of things, those 5 things that I put in that quiz? Those things, salaries and wages, overhead expenses, those things. You add them up, and normally you just take them and put them onto the ITC schedule. There's 2 different schedules on a tax return, right? The issue is, what you gotta make sure is if there's anything hidden in that schedule 37, or section 37 schedule, that is not qualified for ITC, and this is the one. Okay, so as Nina says, you actually have to go back. So you're gonna say this number here, so you're gonna take this, and you can put this as 2 million, put a little 1, and say 2.2 million total less non-qualifying expense used equipment net qualified. Okay? So then we're going to just go back here and erase this to 400,000. Okay, Caitlin? So you got that? Okay. So that was the trick to that question. Okay. So you always have to just make sure, take a look, you have to look at what you put into the pool. Normally you just take them and move them over, but sometimes there's little cute little things in there you have to keep an eye on. Okay? B. Compute the company's net federal tax payable after investment tax credit, assuming the maximum section 37 deduction is claimed. Somebody. We haven't. Let's see if there's anybody who haven't heard from a lot. Anybody? No. Okay. Yeah. Up there. Sorry, what's your name again? I forgot.
Jen.
Sorry. Jen. Sorry. Remember, I forget names, especially you guys. We've all got all certain people say where you guys are. Yeah, Jen.
So we have taxable income of.
Thanks for sitting beside the other Jennifer, because then I remember there's two of you together. Okay.
So we
Okay,
have
go ahead.
Taxable income of 3.2 million.
Okay, taxable income. We're here. Where I just want to see where you're going from. Taxable. Oh, 2.2, right? Before SRED. It's 2.2, right? Oh, sorry, 3.2. Sorry, you're right. Okay. Jen?
And then we have section 37 deductions.
Which is how much?
1.2.
How much?
2 million.
How much, Jen?
Is it 2 or 2.2?
What do you think?
Yes, 2.2.
Remember, what qualifies for an SR, what qualifies for the ITC is not necessarily the same. Right. Okay, so what do you think the number is saying? Right. They already told you they're 2.2. That's the SRED expense. Okay, so net. So net taxable income is 1 million? Then you can see the same person writing these questions is liking using nice round numbers. Jen, what are you going to do next?
And then you apply a tax rate of 16.5%. So you get tax payable of 165,000.
Okay.
But from there you can use your ITC to deduct all of it.
Okay.
Then your net federal tax payable will just be 0.
You're going to do a little lesser of, right? Jen? So you're going to do a little lesser of calculation, Jen, okay?
Okay.
Right? So you're going to do what's the pool balance?
440.
How much?
400.
Good answer. Did you not just hear Caitlin talk about 440 versus 400? Okay, good. So 400, and then taxes payable before is the 165. So the lesser of those is net federal taxes payable. Okay, Jen, you good? Okay. So remember, the lesser of calculation is just what you need to do, right? Because you have to put parameters around what you're allowed to deduct in this stuff. Okay? And you see, what is the amount, if any, of the investment tax credit carryover? Jeremy, what do you got?
Just the 400,000 payable minus the 65,000 used. Like my forward is 255,000.
Okay, so you're going to say open. I always like to just keep it simple, right? So open was 0. Add in what year? 2000 and was how much? 400 from Caitlin? Less
165 used. You get some 235,000.
235. Jeremy? Sorry?
That's
Okay.
165, not 161.
Oh, sorry, that is a 5. Jeremy, was that a cheap shot? Here, I'll do the 6 better now. I yell at my little 8-year-old because his writing stinks, and look at me. Okay. Is that good, Jeremy?
Yep.
Okay. And then compute the company's deduction of exclusion income in the following year if no further SRED expenses are made. Jeremy?
So since you, so your opening balance for the SRED pool is 0.
Pardon me?
Your opening balance for the SRED pool.
So we go to section 37. Section 37.1 pool. Right? So you're going to go open. 2011, bless you, 0, add, what are you gonna add?
You're gonna add the, oh, you're not gonna add anything, you're gonna deduct.
Okay, what I'm gonna do, let's do from the 2011 year, just to kind of do a nice continuity, okay? So let's do the 2011 one and we'll carry into 2012. Okay?
So you add your 2011, which you included in the pool.
So it's 2.2 less deducted in 2011, 2.2. Carry forward to 2012. It's a goose egg, right? Then what are they telling you?
And then you, less what you deducted.
Hang on, I'm just going to put a little placeholder here, okay? Add 2012 SRED expenses. They told us 0 given in question, okay? Just trying to get you, ladies and gentlemen, used to the concept. Start at 0, your starting balance, add less ITCs, end, right? Everybody okay? So starting balance is 0 here again. They told us there were no expenses in the following year. And then, sorry, Jennifer?
Then you would deduct the, less like the amount deducted the previous.
Which is how much? Bless you. Okay, then what you do is you go through just like you do a CCA pool, do your math. You get the pool balance at the end of the year. If it's negative, what do? Negative, what do? Recapture. So that's what we call income inclusion.
Yeah.
Okay, so pool balance to 2013 is a nice 0 again. Okay. Yep. Sure.
Quick question. Wouldn't the qualifying expenses be 2.0 and not 2.2?
No, because remember, qualifying expenses for the ITC pool is different for. So we said the 2.2 is the qualifying R&D expenses. The 2 million is what qualifies for the investment tax credit.
Oh.
Two different types of qualifications. So really, the investment tax credits basically take the numbers from the Section 37 and say certain elements aren't deductible, or aren't includable as ITCs. Okay? And basically one of them is used equipment. Okay? Is everybody good? So that's question, pretty straightforward question. Okay? But remember, try to remember to do your pool balances. It will be much easier to track. Okay? If you try to back end and shortcut things, I find it becomes a little bit more difficult to do. Okay, everybody good? So that's basically R&D for this course. Again, in 18 months, you're going to see it becomes a lot more complicated when you start getting refundable ITCs and the proxy election and stuff like that. Don't need to worry about that yet. Okay, so we're now going to go here. And so this will be posted, so don't go crazy. What I did was I just wanted to go through, I did some slides just to basically kind of go through some stuff. So what I'll do is I'll just lecture from here, okay? Let's do both projectors. No, it didn't work out well, did it? Both projectors. This laptop. Yay! This is where you guys are supposed to say, it's a full term and he's got this stuff. Okay. Let's go through GST, HST. Okay, this course is not meant to be a GST, HST course, but we at least want to get you some basic concepts that when you leave here you can be a functioning accountant and understand some basic concepts. Okay, so the whole idea here is to give you some background information. Find what's in the book. And you know, there should be something on the exam that I'm sure that you guys at least have some stuff. So I wouldn't ignore this part of the course. Okay. All right. So GST was introduced nationally in 1991 to replace the manufacturer sales tax. Okay. So prior to 1991, there was no GST. You guys are all babies, so you didn't care about this. Mom and dad wrote the line buying diapers for you and stuff like that, which is pretty scary because I was actually working then. The GST was in 1991. Before, this manufacturer sales tax was a stupid tax. Okay? The reason why it was a stupid tax, what they did was when you manufacture something in Canada, they taxed you on it. So what they did was they said, okay, you're selling stuff in the United States, we're going to tax you on that stuff before it leaves Canada. So what does that do? What does that do? Does that make any sense? Yeah. Pardon me? decreases exports because you're less competitive because the government's taking money from the people sending stuff outside Canada. That was the biggest reason they got rid of the MSD, was because we were penalizing people who want to create jobs, right? Export's great because basically you do work here, you send it somewhere else, they send you money back, right? Great stuff. These knuckleheads, when they did the manufacturer sales tax back in the 1900s, 20, 30, whatever it was, came up with this concept and it was a dumb idea. So finally, it took many years for the government to say, this is stupid, we should introduce a national sales tax, right? I don't know if you, again, you guys weren't around, but there was a lot of problems about this. People hated it. People hated GST. Now it's part of the world, okay, you still like anything. But when it got introduced, people hated the concept of a GST, especially in provinces like Alberta where there was no provincial sales tax. They just put in a new thing that never existed before, right? So, and the second reason why the government put it in was it was taxing physical products. They weren't taxing services. So there's all kinds of stuff going on in the world was services, right? So what happens over the last 50 years is the world used to be a lot of manufactured goods, right? And what's happened over the last 50 years is the world split. 2/3 of the economy is services. It was opposite 50 years ago. So what they were doing was taxing the one part of the economy that was shrinking, which was manufacturing. So again, this was their chance to kind of say, let's broaden the scope of the tax and also not penalize our friends who are creating jobs and exporting products to outside of Canada. Okay? So that's the background as to why we did get this in there. Okay? Again, basic concepts. When it first came out, GST was on its own. So there was a GST federally, and then there was a provincial sales tax provincially. Again, we've talked about this a couple times with the income tax. The provinces like to tax people themselves because then they can put it on their P&L and say, look at how much money we bring in and how we spend money on hospitals and all that stuff. So the provinces have this provincial sales tax. The problem with that one again was it was only on goods and super goods, right? So, again, they were taxing things. There were a few exceptions, but basically the long and short of it was basically on goods. Things like legal services and stuff like that, accounting services were never taxed. So you knew eventually at some point in time the provinces were going to try to figure out how to get on board. It's taken, Ontario just signed up, last year, 2010, to harmonize it. So what's happened now is, what they said is, the federal government gave $4 billion to do it as well as a bribe. But basically the federal government says if you sign up and become part of the GST, we'll change the name to an HST, we'll take your rate, put it together with the provincial one, and call it HST, which is harmonized sales tax. And literally the federal government tried with about $4 billion to do it, because the federal government likes the concept of having a national sales tax. It's easy to understand, it's easy for businesses and stuff like that. So it started out as a PST, Quebec did the first one a few years ago, and then what's happened is over time, province by province, when they need money, they kind of say, hey, we can get more income because we're taxing more things, services. And secondly, the federal government's going to bribe us with some money. So they literally sign up. The one exception is these guys out west in British Columbia, ladies and gentlemen, in BC, they had a referendum. They hated it so much that they've actually decided to go back and cancel it. They're going to go back to the GST and PST. Stupid, stupid, stupid. It's going to cost them so much money. It's not even funny, but what happens when you get politics and economics not working well. So BC's actually gone back and canceled it. HST is generally considered a better tax because it's simpler to administer for business. Why is that? Why is it simpler to administer for business? Yeah.
I guess you only have to remit it once, because whereas with the GST and PST you have to remit to the federal.
Right, right. Now that you have one tax in Ontario, you have one set of numbers you have to do, right? And as well, the rules are different. Not only do you have two different taxes, but they're based on different things. So you have to have people who know GST and somebody who knows PST. This just becomes a lot easier to administer, right? And the other reason that businesses like it, anybody know what else? Why is the other reason businesses like the GST, HST? Yeah.
I'm just thinking, yes, but if they're operating in different provinces, they have to kind of deal with different types of.
That's not why they like it.
Oh, so
Why would they like the GST, HST concept?
Does that avoid whatever?
Right, you get rid of the second tax, which is fine, but there's another reason why. Emily.
Maybe that you get input tax credits
Correct.
rather than just profit.
Correct. So what happened was, when we had PST, GST, sorry, I'm looking at my back, I think good. When you had PST, HST, or GST, PST, businesses had to pay that. So when they bought things like office furniture and things like that, they paid it, and they didn't get it back. When you put all of a sudden you go to HST, Everything the businesses buy, as long as it's involved in a commercial business, commercial activity sort of thing, they get it back. So you actually saw businesses get a break in this tax, right? When they did this. So that's why businesses like that makes it more competitive, with quotation marks. So competitive because administrative is easy. Secondly, you don't have to pay this second tax, this PST, as a business, right? And what happens is there's a fancy term they like to call it cascading of taxes. Basically, what happens is if you build a tax into a business, the business is just going to push it into its prices anyway, and it goes. It's another tax anyway. Yeah.
But what about all those businesses like restaurants and everything, where they only had one tax before and all of a sudden now they have 13%?
Yeah. No, I mean there are people like lawyers. Like don't forget restaurants. There was already PST. That was the one exception they had. There was a provincial tax on restaurants already, 8% retail sales tax on restaurants. So that wasn't a good one. But lawyers, accountants, when you go to a lawyer account 3 years ago, you paid GST. Now you pay HST. So there was a increase in cost for certain people who were using services who were taxed before, for sure. So there were some businesses who didn't like this, but the vast majority qualified because they didn't get caught by this little whipsaw effect. Right? Okay. So long and short is businesses loved it, governments loved it, consumers hated the concept of paying it, even though they were basically paying a lot of it. They were already paying 8%, 5% a lot of times already in Ontario. The problem is when you kind of see 13 all the time, it just ticked people off. So there was some backlash in Ontario. The good thing is we aren't as stupid as the people in BC where they have a referendum announced in repeal. And they actually have to give $2 billion back to the federal government because the federal government gave BC $2 billion to do this. And now the federal government says you want to repeal it, that's fine. Give us our money back. And BC saying, what do you mean give it back? Well, it's right in the agreement. If you want to cancel it, you're going to give us our money back. I mean, again, it's politics. Sometimes when you let politics dictate economic policy, it doesn't work very well.
Isn't there some items that are still like exempt from that? So like baby formula, things like that?
Yeah, they're basic groceries, which we're looking at. Okay. So we're looking at types of services, types of supplies out there. So we'll get to that in a minute. Okay. Okay. So and don't forget, it's only on goods and services consumed in Canada. So if it's exported, there should be no tax, and that's what they want to promote, right? So you'll see one of the things they try to do is they actually give you, if you have a business that's 100% export, what you do is you're in Canada and you're doing all your stuff in Niagara Falls, Ontario. Basically, you have $100 million of revenues and they're all from the States. So you buy a bunch of stuff in Canada, like a bunch of materials and stuff like that, and pay GST. You actually get that GST back, even though when you ship it across the border, there's no tax. Right? So there's they get full input tax credits, but don't actually ever charge anybody tax because it's all export. Because they're trying to promote exports. Okay? So basically what they said was exports are what they call zero-rated services or supplies. Therefore, they're not subject to GST, HST on sales, but it's a qualifying activity which gets input tax credits. So it's sort of the best of both worlds. Those exporters, they get giant refunds every period because they get all their ITCs, but they don't owe any money. Okay? So it happens. There are businesses like that. Okay? Talk about simpler. Basic concepts again. GST, HST are meant to be end user taxes. What does that mean? What does that mean?
All the taxes get passed along to the person who's purchasing.
Right.
So the end person pays.
Right. So the whole idea of GST, HST, or what they call value-added tax, pick a name, any. I think I put it down there. Value-added tax is the end consumer is the person who should pay the tax. Everybody else along the way, all you're doing is you're just passing it. So what you pay, you get back, and then what you charge, you collect it and remit to the government, right? So basically all the businesses along the value chain are meant to be pass-throughs, agents of the government, that all you're doing is you're taking money from one person and giving it to the government and then taking from another person, netting it out. You're basically a business is sort of indifferent to the tax stuff. It's really you and me as individuals in Canada, the consumer, who pays the ultimate rate of tax, right? And the good thing is, if the investment tax credits and the taxes collected along the way works, everybody's indifferent. Nobody's adding more price along the way. It's what they call the value-added tax for a reason. So what I put here is, the reason why they call it value-added tax is basically businesses effectively remit to the government the tax and the value-added in the value chain. So if they buy $100 worth of goods, they would basically pay tax to somebody along the way on the 100, and when they charge $200, they have to collect the tax. So really, their GST return at the end of the period is 200 minus 100 times the tax rate. Assuming everything they put in, $100 was taxed, and everything they send out is taxed. Really just a difference. And they don't care because it's a flow through, right? So businesses are really considered to be agents of the crown, what they call crown agents in this case. All you're doing is you're basically holding money for the government. So my restaurants, when I collect all that GST for my customers, can I go use that money somewhere? No, you do not. You're holding that money in trust for the government. And what they do is, if you try to run off with their money, they get very nasty. They have what they call personal guarantees, so I have to sign things basis as a person liable as a director of the company, that if the company does that, they go after the people who were the directors and say, you were in charge of these people who ran the company, you took our money, you owe us the money. So that's why basically you're a crown agent, basically you're holding their money in trust. And they're basically saying, you give it to us, and if you don't, we're gonna come get it from somebody. And that's why they have your directors and officers are personally liable for this GST, HST that you collect. So don't go thinking it's all money that I can spend, because if you don't pay it, they get very nasty, very, very nasty. What else did I say? So it's a consumption tax, which is the end user tax, government's level. The next point I made is very important. Why do I say that GST, HST is a much more stable tax? Why governments love it? Because it's much more stable. Why do I say that? Arnold?
Because if, like, during a recession, people spend less, then the government gets less tax.
Right.
But if the economy's doing better, then more people spend more, and then they'll get more tax. So they don't have to implement any changes to the rate.
So you're actually making the argument the other way, then it's less stable, because the economy goes down even less.
Sure.
The economy goes down, you're actually going the opposite way. Okay, why is it more stable than all the other types of taxes? The biggest one is income tax. What happens when the economy goes really bad? Lots of people lose their jobs. Nobody's selling capital gains. Nobody's making all kinds of money. Tax revenues die. Guess what? When you have an economy that's slow, you make a little bit less, as Arnold's saying, but generally you still have to buy diapers. You still have to buy gas. You're still going to go out to the movie. All that stuff still happens, and you still get their money. It may be a little bit less. Economic activity goes down a little bit less, but it's not nearly as elastic. Economists, anybody economists here? Not nearly as elastic as income taxes are, which literally they go like this. When the booming economy, income taxes go crazy for businesses and consumers, or individuals like us. But when you talk about bad economy, guess what happens? It tanks fast, and all of a sudden the government says, where our money go? So if economists ran the government, and actually Stephen Harper is an economist, strangely enough that he doesn't do more, they would do what? What would they do? If I ran the government of Canada, I would do one thing to make the Canadian economy much better. What would I do? With respect to taxes, income tax versus consumption taxes. Anybody want to guess? What would you do? Kate, Alison, get your name.
Increase the consumption tax.
I would increase the GST, HST, and I would eliminate income taxes. Because income tax, basically, you're penalizing people for making money. That's stupid. The problem is it's easy to do. You get a T4, they've taken your money out. People can't escape it. Problem with consumption taxes, what do they? What happens when they're really high? James, what do you
Pay cash in.
People pay cash. I know, whenever I do anything in my house, the guy says, do you want to pay cash, or do you want to pay with an invoice? One's 13% difference. It's exactly what they do up there. That's why the governments have anti-fraud auditors. Probably consumption taxes, they're easier to avoid. Income taxes are hard to avoid. When you get a T4, guess what? They've already taken their money. So the problem is economics and real world don't fit well there. So what happens is you get a combination of both. So I think consumption taxes make no sense. People have money. If you spend money, you pay tax. If you don't want to spend money, you want to invest it, or you want to put it in the bank, that's fine. You're not paying tax. So you should be taxed on what you're consuming. Makes sense. The problem is, again, hard to do when you've got this people doing funny things in terms of evading taxes. Okay, consumption tax, business and registered collector simply passing through what we just talked about. And we talked about the value-added concept. In Europe, value-added taxes are very popular. I don't know if anybody been to Europe recently. You know what the VAT rate is in Europe? Anybody know? How much? 20 to 22, something. So, and the funny thing is the tax rates are still higher too. So their income tax rates are higher than their VAT, and you wonder why their economy sucks. You guys read how Europe's in trouble? Guess what? It's hard to give people a job, get jobs when you're paying 22% VAT included, yeah, it's included. The good thing is when they put the GST in Canada, they basically put it in the law that the GST had to be shown separately. The reason was, that was sort of the way to make sure that the government was held accountable for the fact that every time you bought something, you see that damn GST, right? So it's less likely they're gonna jack it up on you. That's the politics of what they sold to the government, to people at the time. But we'll put it excluded GST so people can see it, so it's less likely we're gonna jack it up on you. In Europe, when it's 22%, they wanna hide it, right? Because when they jack it up to 23, you hear about it, but then it's in the invoice and it's done, right? So I think our system's better because it's much more accountable. If you wanted to solve the American political person, you want to solve the American issue right now, get them to do a GST in the United States, right? They could make their deficit. I don't know if you guys know what's their deficit in the United States right now. Anybody know? Anybody know? This is part of tax policy course now, right? Okay, well, you get 2 for 1 here. What is the American deficit right now? Anybody know?
I'm gonna guess it's about 15 now.
How much? That's the debt, right? The debt's the accumulation, the deficit's in any 1 year, right? So it's about $1.2 trillion. Trillion, that's trillion. Trillion. That's the deficit. So that's each year they spend more than what they take in 1.2, and that's why the 15 keeps going up fast, right? So you can easily, if they introduce a concept like this of 5%, do the math real quickly in their economy, you can pay it down, you can make it go away. Problem is, you guys watch politics. It's deadly down there. You can't do anything. You can't do anything. They can't do anything smart. So they don't know what to do. They can't make any decisions to fix things. At least in Canada, we have a system that when we did this, it sucked, but they did it anyway and said, on we go, and we did it. This will never happen in the States because the Republicans would kill somebody. Literally, they would man the army. They would basically start getting guns. Okay, it's a little editorial commentary on politics. Go Obama. Register. Okay? So a business supplying goods and services and commercial activity you have to register. Okay? So the key is you have to remember is if you're a business, all in one page, I'll give you that shot. If you're $30,000 more than $30,000 in a 12-month period of taxable supplies, you have to register for GST. Okay? That's the long short of this. Okay? Taxable supplies include 0-rated ones and fully rated, fully taxed. Okay? So remember we talked about that export business? When you export, it's 0-rated. They don't charge any GST, HST, but it's still considered part of their revenue base. And the good thing is, when you have taxable supplies, what's the benefit of having taxable supplies? So yeah, I have to register, I have to collect tax. The benefit is, what's the benefit of being a registrant and having taxable supplies?
You don't have to pay tax for supplies and purchase.
You get your investment tax credit back, right? Input tax credits. So unfortunately, they use input tax credit, which is the same acronym as investment tax credit, ITC. So, okay, so you get your tax back when you buy things. Okay, so if you're doing more than 30 grand of taxable activity, that's commercial activity. Basically, you get charged. You have to charge GST and collect it on behalf of the government. But the good thing is you don't have to pay GST, HST on what you buy. Okay, so that's sort of the win you get. Okay, the key to remember here is what did I say here? The only difference from definition of a business really is some things that aren't businesses under the Income Tax Act, charities, schools, universities. They're not considered to be in business. Okay. Sorry. What do I say? Commercial activities defined as carrying them, blah blah blah. You'll see all that stuff in the book anyway. Oh, sorry. What I was trying to say there, I misspoke there. So you have a non-profit entity that doesn't pay Canadian income tax because it's not carrying on business, but it would be required to register for GST, right? Because they are doing activities that other people beside them have to charge GST. So to be competitive, like a gym. So if you have a city of Vaughan where I live, they have gyms. They have to charge GST just like Good Life Fitness does. Because otherwise, it would be disadvantageous to be a gym for the city of Vaughan where they don't have to charge GST, whereas the Good Life Fitness does. So they put them on an even keel. So they said if you're a non-profit company, normally you don't have to file tax returns, but because you're competing with people who have to charge GST, HST, we're going to treat you the same. So you have to register for GST and collect GST, just like anybody else in Canada who's carrying on business. Okay, that's effectively what you're trying to do. Why they did that is to be fair to businesses that are competing with quote unquote charities, cities, universities, and stuff like that. Make sense? Types of supply, this is where we talked about there with Janice. Okay, remember, two types of supply. There's taxable supply, that's the good stuff. Where the government says, you register, we'll give you the tax credits, all good. And then exempt supplies, what the federal government put a bunch of things together and said, you know what, this is what we're gonna call non-commercial activity, and you don't get to get your ITC back, right? That's a bad thing. Everybody agree? So think about it, you're basically out there, you're a bank. I mean, the biggest one is you go to your bank. You don't pay any GST, HST to the bank, right? Your fees for banking or interest and stuff like that. The government said, you know what, we really don't like the banks. They're always easy to beat up on. So what we're going to do is we're going to put you in the bad box, which is exempt, which means, great, you don't get to charge GST, HST, but all the GST, HST you pay, what happens to it? What happens to the GST, HST of the bank? They pay.
Don't get it back.
They don't get it back. So when they introduced these taxes, banks had to absorb a huge amount of increased costs. Because where they were before only paying PST, now they're paying PST and GST on much more things. And the government said, tough luck, Charlie, you're already making $1 billion a quarter. And that's life, right? So the key is, what I did was, zero rated is meant to be very good, right? So basically things that are politically good for the government. So things like groceries. So you go and buy diapers, you're not going to pay GST on that. Okay? Because you got a lot of mothers out there who don't. And you know what? They would be really ticked if they have to buy diapers and keep using GST on it. So they say, we'll put it in the zero rate basic grocery category. Similarly, medical devices, drugs, and the big ones, exports. It's all politics. If you didn't have politics, what would you do? What would you do? You have one tax across the country on everything. Easy to administer, easy to take care of, everybody figures it out. Problem is, provinces are different, people are different, so you have all this stuff figured out, all these exceptions and exceptions. So zero rated are good things because you register, you get to get your input tax credit, but you don't have to collect any tax. Exempt are the bad ones, right? Or what the government feels has already got enough money coming into them. Universities, healthcare, hospitals, what else is there? Childcare, financial services, and residential housing. As far as the government's concerned, all those things get enough money from people and from the government. Tough luck, you can eat. So University of Waterloo, they pay GST, HST. Tough luck, they eat it. Okay? Everybody good? So the key to remember is zero rate is good, exempt is bad. And zero rate is part of the taxable supply group. Okay? When you're looking at taxable supply, you look at zero rated and fully taxed, which is 13%. Those two go together into taxable, and then exempt is on its own, and it's the bad one in the group. Okay? Other admin matters, your sales determine how often you file. So if you're a company, how much your sales are determines how often you have to file. Some file monthly, some file quarterly, some file annually. Just need to know that. Basically, companies have to collect GST and have to remit it to the government at the same time as paying or payable. So you know what? It makes sense they have to match up. This is a funny thing. Consideration. It's all about barter, right? It's all about barter. So basically, you know what? You have to pay GST, HST on a barter transaction in order to be able to say whatever you receive is consideration, and therefore you should pay GST, HST on that. Normally pay cash, but may not be. And then the last one is the one that basically, I think, who is it? Someone just mentioned over here, was it? Talk about provinces. Now that you have provinces that have different GST, HST rates, it becomes very important to say, where is the consumption happening? Right? Think what happens if my restaurant's in Alberta, right? They don't have PST there. They have 5% GST, right? I'm in Ontario, 13%. So when I do things for my restaurants, what rate do I charge them? So my restaurants in Alberta, GST province. I'm in Ontario, and I provide consulting services to my restaurants. I'm in Ontario. What rate should I charge? Allison?
5%.
Why? Services are being provided in Alberta. That's where it's being supplied. That's the rate you should charge. Okay? I live in Ontario. You think Ontario will try to grab it. The problem is I'm supplying the services in Alberta. So the place of supply is Alberta. That's the rate they should apply. Okay? So that's why when you get into businesses that are going across the provinces are all fighting with each other, saying, okay, so the federal government had to come up with rules that kind of dictated where's the price of supply. Okay? So that's, I just want to make that note. And then what else we got here? Anything else? Okay, and the last one is investment tax credits. Just some real quick notes. With respect to capital assets, when you buy $1 million piece of equipment and you pay HST of $130,000, you get all that money back. So there's no amortization of the 130. You basically get it back. You paid the 130, you get it back on your next GST return. Okay, HST return. Will you get that? So there's no concept of amortizing investment tax credit, input tax credits. Will you get that? Okay, so it's basically in the period you pay, you get it back. You have 4 years to claim them. So basically, you know what, if you forget to do it on a return, you have 4 years to find them and ask for the money back. If you have a business that basically splits between two different things, so remember the example I gave you where you have the city of Vaughan, or any city that has healthcare gyms, what they need to do is if the assets used between two different types of activities, they have to apportion it. They have to say, well, 30% is exempt, I don't get an ITC, 70% is tax or commercial, I have to pay that. So then basically what they do is they have to allocate the GST, HST input tax credit accordingly. Okay? So that's what they call apportioning the input tax credit. And the last one is, remember the rules we learned in the Income Tax Act denying certain types of expenses. Cars over $30,000, meals and entertainment 50% is non-deductible. Personal living expenses, golf memberships, those are the 4 big ones. Everybody remember those? Say yes. Then they show up again tomorrow, who knows? Remember, those things aren't deductible. So they're bad. So what happens when they wrote the GST Act, which we call Excise Tax Act, what did they do? What did they do? What do you think they did? So I go and register for a golf course and pay $100,000 plus $13,000 of HST. That's some of the private courses, that's what you have to pay. So you write a check for $113,000 of business. You're going to claim your $13,000 on the golf course? Why not? Arnold?
Because you can't do that regularly, so they put government forces you have to do it.
It's bad. It's bad from an income tax point of view. They don't like it from an excise tax point of view, the GST. So what they said was, those things that are bad for the Income Tax Act, they're just as bad for the Excise Tax Act. You're not going to get that $13,000 back. So the cost of that membership is $113,000 in your books. The thing is, from an income tax point of view, you can't deduct 113 either. So you paid the whole 113 out of after-tax dollars. Okay. That's basically. Remember, there are some things that are that have the same limitations. Yep.
Are there items that are deductible for taxable income but have restricted ITCs on them?
There are some certain transitional things in Ontario and BC. You know what's happening with things like energy and stuff like that. There's transitional rules. So like that. If you get into GST, HST, we'll talk, but not for this. Okay. So this slide, if you know these slides, you're good enough for this one. Whatever's in the book. Okay. That's it. Anybody any questions on GST, HST? Okay, so hopefully with that you can kind of go out there in the real world in a couple of years and hang up your shingle and be able to say, yeah, I understand a little bit about this stuff. That's the information. And we are going to test you on the final just because I have to keep you honest. Okay. Any other questions on GST, HST? All right, let's open up the floor to, and by the way, this lecture is being, what do they call it, tape recorded at every call, so you can listen to this again and again if you want. But, who's laughing? Allison, come on. That's not right. What, anybody any questions for the exam tomorrow? You go home now if you're done, if you're ready for tomorrow. You can leave, or you can stay and ask questions till 10 to 1. Arnold.
Are RTCs only, can they only reduce federal taxes, or is it for provincial taxes as well?
Well, they're all together now. So when they're harmonized, it's all one return. Okay, so they're all filed together. That's the nice thing about it is it's one return. That's why it's called harmonized.
Okay.
Right. So basically, you come up with your net tax payable for the period. You either get a refund or you pay an amount. That's just the calculation. There's no difference anymore. Right. They just basically tack the two rates together and say that's it. The nice thing is it's really quite easy to do once they put them together. All right. Questions? Anybody any questions for the midterms or any topics you say, I don't get this? There's not a lot of posting yesterday. I wrote up, I was up till midnight last night. Thank you all very much for that. Janice?
If I
can remember correctly, there was a question, this video that Marco did, and it's issues regarding the issuing of shares. Is that considered, that was added back to financial income, so that means it wasn't deducted. Could you explain why?
Okay, so, question is, what do you do with the cost of raising money?
Wouldn't you first add it all back and then deduct 20%?
Correct. So the key to remember is, Section 18, my friend talked about it over and over and over in his course. Section 18 says, these are things you can't deduct. Everybody remember that? So if you go through Section 18, it says, thou shalt not deduct the following things: personal living expenses, capital expenses, a whole bunch of things, right? So what you're going to do is, when you're doing these reconciliations, if you ever see one in the future, and you're going to do tax returns, you're going to see them every tax return, that says, those things you can't deduct. So you're going to add them back at the top of your schedule, right? Meals and entertainment, 50% non-deductible, golf memberships, a whole bunch of things that we talked about. Those are all bad things under Section 18. The issue is, remember we talked about in class, when they say no in Section 18, what's the next thing you do? First thing you're going to do is add it back and say, okay, they caught me here. What's the next thing you're going to do? You're going to go to Section 20 and say, is there any other provision that may help us? So let's look what happens. The mechanics of this, the simplest example. Depreciation for accounting. So the accountants book $1 million in depreciation. What does Section 18 say? Why?
Because it's an accounting thing and it's not a tax thing.
But more importantly, it's on account of capital. It's not deductible, right? So Section 18(1), B, C, whatever it is, one of the two of them, says you cannot deduct amounts on account of capital. Depreciation is an item of capital by definition. Therefore, you can't deduct it. So you have to add it back. So every schedule we've ever looked at, depreciation, amortization, what do we do? Add it back, right? Fine. So you're going to add it back on the top of your schedule. Problem is, you're going to say, that sucks. I bought this equipment and using it in my business. That doesn't make sense. You're then going to go to Section 20 and say, is there something that allows me to do this? And I get some benefit from this expense. What is it? CCA. That's what CCA is all about. Is now you're going to go and say, okay, at the bottom you can have a deduction for CCA, which was specifically allowed. Remember that 2x2 matrix that we did in class, ladies and gentlemen? Reconciliations. Remember reconciliations of accounting and tax income? You, ladies and gentlemen, all remember this reconciliation stuff? You start out with what? What do you start with? Yeah, Jen. Okay, accounting income. So you're going to start with accounting income. XXXX, whatever that number is, and that's not to be triple X like the bad stuff. Okay? I'll put another one just to make sure that you guys are reading this at the wrong time of night. Okay? Okay? What's the 2x2 matrix that we talked about that allows you to kind of, and what you're going to get down to the bottom of here is net income for tax, right? So you're going to do a bunch of rigmarole. You're going to come up with net income for tax, division B income. What's the pluses and the minuses? Just at a conceptual point of view, come on.
It would be, you would add back things that are deducted for financial accounting, but not for tax purposes.
Okay, so the first thing you're going to do is you're going to put a little add up here, and you're going to less down here, right? Everybody remember that? Top is add. It's just a convention. First thing you're going to do is, as Tremon's saying, is you're going to say things that you're going to add back. So these are things that accountants have deducted. You're going to say you can't deduct. So you're going to say add back non-deductible expenses. Right? And they're principally found in where? Section 18, right? There's Section 67. There's a bunch of other places, but let's just say Section 18 mostly. Okay, I underlined expenses. Why? In our little world of 2x2 matrix, as soon as I said you're adding back expenses that aren't allowed, what's the next thing? What's the next thing that we talked about in class as a nice little thing to remember? So let's go down here. So what I was trying to get at here is, this is certain things that you're not allowed to deduct. There's always some things that you may be able to deduct. So you're going to say here is less expenses allowed for taxes and not accounting. It's somewhat symmetrical, right? You got certain types of expenses here that you can't deduct. There's certain types of expenses that you can deduct from a tax point of view that you can't from accounting, right? I.e., and that would be principally section 20, mostly. Okay? There's only two types of things generally in your P&L that you deal with, right? Expenses, we just dealt with. There's really, in the expense pool, there's three types. Expenses that are the same for accounting and tax. Do we care about those in this purpose? Do we care about those? No, don't care. They're in that XXX, the fourth X is important in this case. Okay, the fourth X is important. So it's in that number, it's the same for both, who cares? Don't worry about it. This is all about reconciling the differences. So the first one is, there's a bunch of things in section 18 you can't deduct, you add them back. Right? Meals and entertainment, blah, 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 capital expenses, blah, blah. I'll get to your answer again in a minute, so this is my little sidebar, okay? Down below is, there are certain things that you're allowed to deduct for tax point of view that the accountants don't know about. Things like CCA, CEC. Accountants don't know what that means. You go to most accountants, you're like, what the heck are you talking about? Right? But you're allowed to deduct what take them. Okay? Now we've dealt with expenses. There are either expenses that are the same, they're either deductible for tax and not for accounting, or vice versa. Okay? What's the other part of the reconciliation? Okay. Now the other one's got to be the opposite, right? Everybody agree? You only have two types of things: income and expense, for effectively for a tax return. So how do they sit here, Jennifer?
So you would add back the income inclusions not added.
So these are income items not required for accounting. Okay? Where do you generally find those? So that says income items not required for accounting. Where would you generally find those? Anybody know? Section 12. So these, remember, same thing for revenues. Revenues that are the same for accounting and tax, do we care? In this purpose, we obviously care about revenue, but for this purpose, do we care? They're the same. They're not reconciling items. Who cares? We're good. We're only caring about here is incomes that are income items not required for accounting. So the accountants say that's not income. The tax guy says it is. Section 12 goes that. The big one would be what? What would be the biggest one? Anybody know? It's the biggest one in section 12 we're talking about. Somebody gives you a bunch of money ahead of time. You're going to pay tax on that, right? Payments received. So basically, you know what? The accountant will put that in the balance sheet and say it's deferred revenue. The tax people say, tough luck, Charlie. You got the money. We want our money, right? There are some reserves allowed in section 20, which down goes down here, right? So now we've talked about revenue. These are items that were required for tax, but not for accounting. What's the flip now? Jennifer? So this is income that's not taxed for income for accountants that isn't taxed. So this would be, and then the other one is, so this is this one and this one. This is income not accounted. How do you want to say this? Income not included. Geez, that's terrible. Income not included in accounting. No, sorry, income included, this is the wrong way. Sorry, guys. This is section 20, mostly. Up here, let's do this, mostly. And this is income in accounting not taxed. What's the biggest one there? Gains. When you record a gain on accounting, you include it in accounting. So what? Tax people don't care. Take it out. The other big one is capital dividends. So they're included in income for accountants. They put it in that XXXX. The issue is they're not subject to tax. Take it out. You don't want to pay tax when you don't need to. That's it. If you remember that, that's the easiest way to remember this. So back to Genesis question. Sorry, Genesis. Long and short, right? What happens is you ask about financing. Section 18. Raising money is a capital endeavor. Pretty agree? You're raising capital. You can't figure that out as capital. Pretty simple. non-deductible. So you pay lawyers' accountants $1 million to raise $100 million. Probably over, it's usually so it's about $2 million. You pay lawyers' accountants about $2 million. Okay? You can't deduct it. So guess what? On your schedule, you're going to show non-deductible financing expenses $2 million. The person I'm sure showed that. Now, what happens is, the government wants you to raise money to start businesses and stuff like that, so logically, you're going to try to look in section 20 and say, is there something that's going to help you? Where that is section 21E. It says, those expenses, you can deduct them 150 over 5 years. So you're going to have an item for the next 5 years that shows 2 million divided by 5, which is 400,000, as an expense deduction at the bottom part, every year for 5 years. Right? If you remember that process, you will do very well on these questions, because it just after a while, it just becomes a, and trust me, you start getting into, I mean, I've done $1 billion tax returns. The only way to do this is to think through, okay, how's it taxed, who's getting their money when, and you have to run the schedule that way. Okay? Yeah.
So you know how gains are paying off here, and if there is a capital gain, I want to add it back to the bottom before we get to the before tax, which is a division B, right?
Right. Well, remember, this is a reconciliation of division B income. And we didn't say use section ordering rules of section 3. You would put in here. So you would in this case, what you would do is you would take out the accounting gain, so you're less the accounting gain. So just asking about a gain or loss on the sale of an asset. Let's say it's a gain for accounting and a taxable capital gain for tax. Okay. What you're going to do is the first thing you're going to say is that gain for accounting. We've already said you take it out the bottom. Everybody agree? Gain or loss for accounting. Who cares? Gone. Doesn't mean anything to anybody. The problem is, now you have to determine what the tax situation is. You come up with a taxable capital gain. That is a income item that's specifically required under accounting, that's an income item not required for accounting, is a taxable capital gain. Accountants don't know what a taxable capital gain is. So section 38, calculation of taxable capital gain, would go in at top. So again, you have to look at both sides of the equation. In or out, right?
Also, moving to the extent that we have to order an answer in terms of ordering whatever we did here, or can we just go by whatever you give me the question? So
you can do whatever you want. For me, the easiest way to remember this is conceptually breaking up the adds and subtracts, because guess what? Whenever I put a plus in the top, I try to put something at the bottom. I almost always. And a lot of times there is a subtraction. And if there's not a subtraction, what do we talk about in class? So let's just say it's a capital expense that doesn't go, that isn't deductible under section 20.
I think you were talking about how it can affect the cost.
Right. So let's just say you have something. Remember that example we had in class? We had that they had a vacant land for a day, for a month, and they said, well, that's denied by section 18, whatever it was, right? So we had that back at the top. The problem is there's nothing in section 20 or anywhere else that allowed a deduction. You're like, oh, that sucks. I paid $2,000. I'm not getting any benefit. Benefit being a tax deduction eventually. The good thing is that $2,000, invariably most of the time, you can add it to the cost of the asset. In this case, you would add to the cost of the land. And when you sold the land, you at least have a higher cost base on lower capital gain. Right? So remember, when they say no under 18, try to find something somewhere else. The other notorious place to find is, you know, you spend $20,000, remember you used the example in class, $20,000 fixing windows? That is not, I hope so. I own a building, I pay $20,000 to fix the windows, and I deduct them from an accounting point of view. I say, no, those are repairs. The tax auditor comes in and says, you're full of crap, that's capital. So they say, you can't deduct that. It's 18.1B, add that back at the top, $20,000. You just say, thank you very much, I'm done. What are you going to do? Allison? You're going to put it in your UCC pool and take CCA. So you're still going to get your $20,000 deduction. It's just going to take you some time to get it. So you add it to the top, you looked around at the bottom and said, okay, well, I can't take an immediate deduction, but I can take it over time as a CCA. And last one is, if I can't take it at the bottom, is there someplace I can stick it as an addition to an asset cost that can help me down the future?
a question about class 1 class 1 for CCA.
Yeah.
You know, there's class 1 and there's class 1 non-residential and like class 1 for manufacturing.
Yeah.
Do we just automatically assume that we're having a new purchase in the future, like I don't know, like 2011, we would always pay the non-NDR or the
Depends on what the question tells you what the deal would go.
Because like I know like on the textbook it says that the class 1 on its own, which is 4%, is the most common one.
It's the most common one.
But in all the forms that we can do, like every time we said that there's replaced the proper or anything, we've always put it to the manufacturer.
or it's other class. Okay? Yeah? Don't, I mean, we're not testing whether or not you know class 1 versus class 1 versus class 1. You want to know, you know, to put it in the class and where to look for, and where you need to schedule such a class up. Yes.
In problem 416, how come interest regarding share purchase was deductible? Because it is based,
Interest?
Yeah.
Right, yeah. Oh, interest. Well, interest is another animal, right? Interest is, again, the thing is this chart's serving us well today. Interest is, the courts have determined in Canada, interest is defined as a capital expense, therefore non-deductible. So generally speaking, you would add that. The good thing is, the government says, well, that's not really good. We want people to raise money and pay interest because then that allows us to get bigger economy and all that stuff. So then they put in section 21C, which says, certain conditions are met, you can do that for interest. So, long and short of it is, interest is the same for paying a tax most of the time. As long as you meet the rules of section 21C. Okay. So, interest on most things is deductible. But if it says if you paid interest on building your cottage, and you put it through your company, what do you think is going to happen? What?
Based on capital, it is not to earn business.
That's it. That's it. So section 21C, where it says interest is deductible, one of the things in the preamble says, as long as the money is used to produce business income or profit. Guess what? For the cottage, I don't think producing income there. Anybody else? Yes, kind of ran through your perspective then. Is that why nobody's asking questions? Yeah.
Just the type of questions that will be asked on this exam. Will it be more of the, like, I know how much of the conceptual like question will be expected? How much written compared to actual calculations? Because I know like
There'll be a combination of both. There'll be a combination of numbers and and some conceptual. Okay. And think about it in class. The majority of the stuff is numbers, so I would think you're going to see more numbers than less. Right? Fair enough? Whatever, I posted it 3 times last night, the same thing. Stop asking questions about what happens in the full moon on a Thursday in July when it's over 35 degrees. We didn't look at it in class, don't worry about it. Okay? People are asking questions about these things that are, I don't even understand. Okay? How am I going to test you on? What we did in class is what you're going to be tested on. Okay? Fair enough? Including the types of questions, including the concepts. So if you can do the questions in class, you'll be fine anything.
For acquisition of control, for the max selection method, do we always deem to have sold all property that is accruing?
Did you read my post last night? Please. I get so excited about this. I wrote about it 3 times last night. Literally, the same thing 3 times. Do not get tied up with this maximum election nonsense. All that means, remember, you have an acquisition control. You do your year end like you normally do, right? Everybody remember that? You have your year end, you do your numbers like you normally do. You stop, then certain things happen because of the acquisition control, right? The year end, which basically means, okay, you have to file a tax return. More importantly is, everything that has a loss, you have to figure them out and take those losses. Everybody agree? Step 1 has nothing to do with any elections. You got to do that. Step 2 is, if you have no losses expiring and stuff like that, do you care about elections? No. The election is meant to help you eliminate losses this year, right? That's what the election's for. Otherwise, you're nuts. You're doing election, you're creating income when you don't need them. You're going to pay tax, you don't need to. The election is only meant to help you eliminate the effect of losses expiring. What happens is if I've got $10 million in losses that are going to expire, and I have $1 million in accrued gains, what's going to happen? So I got $1 million in accrued gains that are on capital properties that I can collect on. I get $10 million of losses when expire. Okay?
So the remaining would expire.
You're going to lose the $9 million. You're going to do the max. The only reason you do the max is because guess what? You need it. Right? So that's what the maximum election tells you. That's the most you can get. Tough luck, you're going to lose some stuff. Generally speaking, you're going to have a situation where they're going to tell you, here's our losses that are going to expire. You're going to look at the number of gains you have accrued, and you're going to compare them. And guess what? If the gains are more than what you're going to expire, what are you going to do? You're going to do the partial. That's it. don't get all fussed about terminology, about maximum and partial. Don't know what those things mean, because again, they need to think about this and say, the maximum is the case where I need all the losses, I'll make them I can. How often is that happen? Probably not a lot, but we'll tell you, we'll say, guess what? 20 million of losses, 3 million accrued gains, you better do that maximum, right? Okay, so don't get too fussed about maximum versus partial. You'll be able to tell from the question what you gotta do. Okay? Yeah. Yeah.
For that, like I noticed that we did a class for the acquisition control, we started with, like how we weigh with non-election, so we did the division B income, and then we did adjustments for it.
Yeah.
But I did notice that the other classes, so in the other sections, that was approached differently, so they didn't start with no election, it was more.
Yeah, that was just because I was teaching you what the division B looked like without any elections. And then I went into maximum, and then I went into partial.
Right, so on the exam, do we?
Just do what
follow
you're
that
required to do.
format? Okay.
Read the required.
Okay.
We will say to you, and you know what, because I know people will start spinning their wheels, the questions are written that you should be able to read exactly what you're supposed to do, and you should do that, okay? Is that fair? Don't create questions that aren't there. Don't create work that's not there. Okay? Is that fair? Katie, you know, good comments?
Just for the concept of the carryovers for losses or donations or anything, when they say 20 years, that's always a taxation year, right?
Yes, it's taxation, always taxation. Don't care about calendar years. In fact, most companies don't care about calendar years at all. Okay.
Question was about accruing losses only for acquisition control. And secondly, I was wondering if, for example, if you
What was the part?
the first one was like, so you only accrue losses if it's AOC, right? Like, I mean, if it's a normal year end, then you wouldn't accrue losses.
Yeah, the only thing I do is obviously inventory should be valuable on cost of market. Right, but that's just normal accounting. Accounts don't do that.
And those accrued losses would go under business loss, right? So
Depends. So the accrued loss, so the question is, do all the accrued losses go to the business loss? And I say no. What?
Is it so if it's an account, like for example, if it's a capital on a depreciable property, then it would be a allowable
You
capital
cannot have a capital loss on depreciable property, I'm going to hit you over the head. Remember we said that 5 times in class. You cannot have a capital loss on depreciable property. How does the tax system work on losses on depreciable property? CCA. So if your UCC is here and your fair market value is here, you have to take the loss down as deemed CCA. Goes through your business, just like any other CCA, right? You can have a capital loss. Let's say I'm a company and I have bought shares in REM. It's very true around here. I'm sure there's people who bought REM. And I paid $1 million and I have an acquisition control and they're worth $100,000. And that's probably what some people are facing when they bought REM. Right? There's a $900,000 loss. That is a capital loss. That has nothing to do with business that you have to trigger on the acquisition control. Okay? That's not going to the business. Okay?
But you can't have a capital loss on non-depreciable.
Yeah. Hey, that's what it is. That's what the capital loss for is, not depreciable property. Right? Okay. Depreciable cannot have a capital loss, so the only place it can be one non-depreciable. There you go.
Can we just generally assume on the midterm that if they had net capital losses, then they would claim those in order to increase to keep like the non-capital losses here?
Again, there's a post I sent last night. You should read these things. There's 2 hours less sleep last night because of this. Remember in class we stated our objectives. When you do an acquisition and control, what were the objectives we set? So we have a year end. We did our numbers. We had all these losses that got triggered. Some losses were going to expire. What were the 2 objectives we set out when we did the acquisition control numbers? Do you remember? Number 1 was, yeah, Allison.
Do you know how to maximize the loss carry forward?
That was the second one. So number 1 is make sure no losses expire. Number 2 is maximize your non-capital loss carry forward. That's the 2 objectives we set out in class numerous times. I would do, let's say you face a question like this, just say that. Say, assuming you want to maximize your non-capital loss, and generally speaking, when I do the market meeting, which you probably do tonight, I can assure you, I would put extra marks when you're actually showing them you're thinking what you're doing instead of just spitting back what we talk. Okay? So regurgitation gets marks, but it doesn't get as much as thinking. That's why I like to design market keys. Whether or not I get that through Professor Mark, we'll see. Because I did no speak to him, so he's got to prove the market key. But that's how I like to do market keys. I'd rather give 3 marks for somebody who's done something thinking-wise than 3 marks for spitting crap. I mean, I know you guys can tell me that Nielsen Entertainment is not a dog for 50%. I get it. mean, if you don't, then you probably should be there. You're gonna get a mark probably, but guess what? Shouldn't get as much as somebody just said what I just said there. Assuming that you want to do this and this is what we're doing. That means that, okay, I get the concept. Yeah.
Can you go over how, when two things are being disposed of together and you only have one proceeds for both of them, so you have land and building?
Yeah.
How would you allocate the proceeds for both the land and the building?
Okay, so is this generally just land and building? Because
Yeah.
generally speaking, when you sell assets, you have to allocate the proceeds. Okay, everybody agree? So your job when you're doing a tax return and accounting and everything like that is you get a valuation and you say, okay, this is what we sold it for, you split it up and you allocate the proceeds. The only time you have to worry about 1321.1 is when. Again, this is when I would award more marks for somebody understanding why as opposed to just jumping into a calculation. Janice?
Does it cover a loss for building?
If the proceeds allocated to the building are less than the UCC, then you have to go through that calculation. Okay? If the proceeds allocated to the building are more than the UCC, you don't have to worry about it. Not an issue. Okay? It's the same thing as what Janice just said, but for me it's easier to remember. Look at your UCC compared to the proceeds. Don't need to worry about terminal loss stuff. I mean, that's the product of it. Right? So, do we need to go through the numbers or? We did it in the book. We did it in the book and stuff like that. Remember, all it is basically you take the combined proceeds and then take off the deemed proceeds for the building, which is the lesser of calculation to come up with the calculation for the building, and the land is the plug. Remember that?
Right.
And then lesser of is it's in the book. I don't want to spend 5 minutes going through something that you can see. Okay. It's the lesser of, the total proceeds minus the greater of, or the lesser of the ACP of the land and the fair market value of the land. You get your number, and then the greater of the fair market value of the building model. What else? Yeah.
On a voluntary disposition, if say a building gets destroyed and you like acquire another one or build another one later on, and it's in the same class, would it be the same as if they were in different classes? Maybe the textbook they would be separate. So it's still the same.
You're saying you're still allowed to do that.
Okay.
The act is structured so that just because they change the rules on which class is which, shouldn't cause you to not qualify for the replacement property rules.
Okay.
So we should be able to.
So we would still do that kind of amended return and everything.
Yeah. I think that makes sense, right? If it's not fair, they change the definition from class 1 to class 3 or whatever they do, and all of a sudden you can't get those type of things. So they're trying to do that. Okay, last 3 minutes, don't go yet. I'll you two up if you want, but budget 5. Last 2 minutes, anybody have any question? Okay, so remember, read the question, try to see what we're looking for and answer it that way, as opposed to just starting to spiel off answers, because you will wind up wasting time. Guaranteed. What else, got anybody else? Yeah.
So the TCA, when you're prorating, it talks about the whole like within the first taxation year. Is that
first
like
taxation year.
Yeah. Is that half? Like say if I bought something half of the year, those 6 months is that officially as the first taxation year, or is it the first full taking it?
Depends on how you define your taxation year. You get to define your first taxation year. So if I incorporate a company on June 1st, that is the first day of my taxation year. If I pick May 31st as my taxation year, your first taxation year will be a full year. You don't have a proration issue. It's only if you pick another day other than May 31st that you have less than 365, then you have to do proration. And all the rules about half year rule and all that stuff are all the same. Okay? It's always the same.
For AOC, there's a deemed year end, that's not prorated, right? For CCA? It is?
Taxation year is less than 365, you're going to prorate. Don't forget, somebody else posted the other day, what's the difference between a half year rule and what's the difference between a half year rule and the half net adjustment that we do? It's the same. That's what the half year rule is, just the half adjustment. They're the same. I told you how we missed that in class, but we do a half adjustment, that's the half year rule. I don't mean to make fun out of anybody in this class, that's not my intention. But, remember, the half year rule is on the new costs over the proceeds, right? So when you look at the half year rule, you look at what you pay for in a year less what the proceeds are. If you have proceeds of more than the cost, so if you dispose of more than what your cost in the year, you have a half year adjustment. So I spent $1 million on new equipment and I sold $2 million. I had proceeds of 2 million of other equipment. Do I have a half net adjustment here? No, you don't.
Isn't it that you have an addition of more?
It has to be the addition one. So I said you added one, but you took away 2 million. There is no half year adjustment because you sold more than what you bought. Okay, the half adjustment is only on the net addition within the year. Okay? And I can see when I read the posts, people don't get that. They do the half adjustments first, and then they pick up the source. That's right. Okay? All right, the last one, I gotta get
If
to.
there are two assets in pool, and after like we sell one of them, and there will be like negative, that there's moving
Negative CCA pool. Ladies and gentlemen, negative CCA pool. Don't care how many assets you have. You got a trillion assets. You have to be rude.
But then what happens to all the other assets? Like now that's zero,
Then
there's
no
no
CCA.
CCA. So then you just
But you're going to take depreciation on the thing that shouldn't be depreciated.
But then like so like those assets remaining at zero. You see,
No, no.
but when you sell those, do you have to do
You have another recap. Lower cost of proceeds and then after those get recaptured, recaptured. Yeah, recaptured. Okay, see you tomorrow.